Imagine you need $10 million in cash. You have it, all of it, sitting in stocks. Most people would sell, the wealthy don't. And what they do instead reveals something about money that almost no one has ever taught. This isn't a loophole. It isn't illegal. It isn't even complicated once you see it. But it operates so quietly and so far outside the financial education most people receive that it might as well be invisible. What you're about to understand changes how you see wealth entirely. Here is how most people think money works. You earn it, you save some, you invest if you're disciplined enough. And when you need a large amount for a house, a business, a crisis, retirement, you sell whatever you've built up. You convert your assets into cash. That's the move. That's the model. And for most people, it's the only model they know. There's nothing wrong with it, but it has a ceiling built into it that most people never notice. Because every time you sell an asset that has grown in value, two things happen. And the second one is the one that quietly reshapes the entire game. The first thing that happens, you lose the asset. The thing that was growing, sometimes for years, is gone. You traded a machine that makes money for the money itself. The second thing, you trigger a tax event. In most countries, selling an investment at a profit means you owe capital gains tax on that profit. Depending on where you live and how long you held the asset, that's often between 15 and 35% of your gain. Not your original investment, your gain, the portion that represents your success. So the better your investment did, the more you hand over the moment you sell. Run the numbers on something real. Say you invested $1 million 10 years ago. Today, it's worth $10 million. You've created $9 million in profit, but the moment you sell, you might owe $2 to $3 million of that in taxes. Immediately, automatically, without negotiation. Now you have $7 million instead of 10, and the asset is gone. Here is where the wealthy do something completely different. Instead of selling, they walk into a bank, or rather, a private wealth desk at that bank, and they use the $10 million in stock as collateral. The bank looks at what they're holding, confirms the value, and offers them a loan, sometimes for 50 to 80% of that value, at interest rates that, for someone with serious assets, are often lower than a standard mortgage. The wealthy person takes that loan, gets the cash they need, and their stock, still sitting there, still growing, untouched. No sale, no taxable event, no giving up the machine that produces the wealth. This is called a securities-backed loan, and it is one of the oldest, quietest mechanisms of serious wealth preservation in the modern financial system. Banks love this arrangement. When a client pledges $10 million in highly liquid stock as security, the bank's risk is close to zero. So they compete for these clients, they offer favorable rates, they make the process easy. The bank earns interest, the client keeps their assets, and the government collects nothing, because nothing was sold. Now here's the question that makes this entire picture click into place. How does the wealthy person repay the loan? In some cases, they repay it from income, dividends, business revenue, cash flow from other investments. In other cases, they refinance. They take out a new loan, retire the old one, and the cycle continues. And here is the part that most people miss entirely. While all of this is happening, the underlying asset may have grown enough that the loan becomes an even smaller percentage of its total value. The collateral appreciates, the debt stays fixed. The gap between what they owe and what they own quietly widens in their favor. This is not passive. It's a structure, a system designed around one core idea. Assets are not meant to be spent. They are meant to generate the power to borrow. Think about the founders of major publicly traded companies. These are individuals who often hold billions of dollars in a single stock, the company they built. If they sell large blocks of that stock, two things happen. First, they face an enormous tax bill. Second, the market notices. A founder selling their own stock at scale sends a signal that something may be wrong. The stock price drops. Wealth is destroyed in the act of trying to access it. So they don't sell. Instead, they borrow against their holdings. They fund their lives, their investments, their acquisitions, all through debt secured by assets they never actually give up. The asset stays. The wealth compounds. The debt is manageable. And the tax bill never arrives. Now place that beside the reality most people live in. When a financial emergency hits, a job loss, a medical bill, an unexpected disruption, most people have no choice but to sell. The car, the investment account, sometimes the house. They liquidate their future to survive the present. And every time they do, they fall further behind. Not because of bad choices, but because the system they're inside offers them no other option. You can't borrow against $20,000 in an index fund at the same terms a billionaire borrows against a $10 million stock portfolio. The access is different, the terms are different, the entire experience of debt is different. For most people, debt is a consequence of not having enough money. For the wealthy, debt is a strategy for never having to give up the money they already have. That asymmetry, operating quietly and visibly across decades, is one of the central mechanisms of how wealth concentrates. It isn't about corruption or conspiracy. It's architecture. The financial system was built with mechanisms that reward holding assets at scale, and those mechanisms are largely invisible until you have enough assets to use them. This matters because it changes what the goal actually is. Most people are taught to think of wealth as a destination: save enough, invest enough, build up enough that one day you can sell and live off the proceeds. Assets as a finish line. That model makes sense when you're starting out, but it describes a world where wealth is something you eventually consume. The wealthy operate in a different world entirely, a world where assets are never the finish line. They're the foundation, the thing you never sell because selling it means losing it, and losing it means the system stops working for you. The shift isn't in the amount of money you have, it's in the relationship you have with what you own. Do you hold assets to eventually spend them? Or do you hold them to borrow against again and again and again, while the assets keep consumption? The other leads to perpetual leverage. Understanding this won't immediately put you in the position to use a securities-backed loan, but it does something else that matters. It corrects the mental model. Because once you see that the wealthiest people in the world are not trying to accumulate enough to sell, but enough to never have to, the entire strategy of building wealth shifts. The question stops being, how much do I need to save? It becomes, what can I build that the financial system will lend against? The rich borrow instead of selling because the loan gives them the cash, but the asset keeps the wealth. And the asset, quietly working, quietly compounding, quietly growing beyond the reach of any single tax event, is the whole point. The goal was never the money. The goal was always the machine that makes it.